All right, good afternoon, everybody. This is Ken at Tortoise Capital. This is the pre-meeting webinar number 2 on 22 April 2017 for the Advanced Swing Workshop that we'll do next month in Raleigh at the Van Tharp Institute. This is a quick look at the agenda. Covering the introduction now, I want to give a little overview of the topics. So today's topics were these. I was looking for you to have reviewed information on the regression line crossover and Bollinger Band framework, the plan, prepare, execute, assess process, what I mean by calibrating the normal move or the expected move. Showed you some videos on trading in the pocket and chain trading. These are two concepts that have emerged from our chat room trading practice on both intraday and swing trading, and it turned out to be very useful concepts for trading the patterns both intraday and swing. Showed you some material on universal entry, green, yellow, and red zone trading, the 2R battle drill. Notice I must have just put these together. And then the concept of swing trading one day at a time, and invited you to send me some questions on those. I have a dozen or so questions that I'm going to get into here shortly. And then I have some additional materials that I want to cover about personal adaptations that folks have made to the swing trades and ways they've refined the rule sets for their use. And these are presentations that come out of our Kansas City Research Weekend. And they are, I think, powerful presentations and good information for you to have, and it may trigger some more ideas for you about how to apply or adapt swing trades to your own situation. And it's an example of the kind of goodness we get from participating in a community of practice that shares ideas back and forth, so we all can work to help each other get better. So I want to share some improvements on the channeling system, which is as vanilla as we can get, and then what the effect of applying the risk Z indicator is as a way to do market classification. So those are the things that I'll cover today. I was going to show you some info on the chat room about how to use that. I invited everybody that attended last week to the chat room. If you have not gotten into the chat room or you didn't get an invite, I would ask you to send me an email today to bongke@yahoo.com so that I can send you the link, and so you can get in there and start noodling around and see what it is that we do. These are the topics that are scheduled for next week's questions and answers, and these have more to do with psychological prep and process preparation. Although if there are additional questions that come out of the content from week 1 and week 2 or any of the background material, I will also do Q&A next week on those. So any questions that you have, that'll be the catch-up portion. But we'll be talking about zero state trading psychology, swing trading as part of the total trading plan, how to find your sweet spot, more examples of people that have adapted the rule sets to their own personal situation. I'll talk a little bit about daily debriefing, gratitude, and forgiveness as part of the psychology. The ideas of Japanese Nikon philosophy as a way to deal with the psychological challenges of trading. It's an adult way to approach life. And I will review once again preparation of the daily plan and the execution of the daily trading plan, putting things into practice. So I want to make sure that you have a clarity on how I do that or how I suggest doing that. Okay, so that's the outline for today and for next week. And so let's dive into the Q&As then. Okay. Okay, so the first question was, can I please explain relative volatility and the risk index measures in the market mosaic? Yes, I can. So the first thing, excuse me, I want to talk about on the risk index is the background of it. So the research on comes from some academic work that studied the VIX, and that's the measure of implied volatility on the S&P 500 options, and it's considered to be a measure of short-term trader nervousness and anticipation about the direction of the market. The general rule has been that when the VIX is rising, that the market is going down, that a rising VIX is bad. We can apply some statistical treatment to that, and we can say that when the VIX is very quiet, that in general, that has been favorable for the market. That when the VIX has been extremely volatile, that has led to excessive short-term failures, but then also periods of remarkable rebounds, so like dead cat bounces. So it turns out that when the VIX is in either of these extended conditions or extreme conditions, whether it's quiet or volatile, that there are certain strategies that should work. That when it's very quiet, you are generally wanting to be long and let the market grind upwards. But like anything, when things get too quiet, we want to be prepared for these sharp, sudden volatility spikes that shock the market. So it says take advantage of the long side, but respect your stops so that you can lock in the gains that you've made. Because if we think the market goes generally up, then has these periodic spikes down, this is where that volatility shock comes from. And that the quieter that this move up has been, you will see the VIX declining. So if we had the VIX indicator down here below, as the market goes up, you would see the VIX declining. And then when it gets very quiet, and you get these sudden shocks, it's like throwing a big rock into a very still pond. You get real sharp shocks in volatility. Well, if you look back over the last 5 years, over the last 25 years, and now you take a look at volatility as measured by the VIX, what you will notice is that things will be very quiet and just muddle around, and then there will be one of these sharp spikes like this, and the VIX will shoot way up, and then it will roll over, and then you will have this period of decaying volatility until it gets back to normal and even quiet. And you get another big shark fin looking thing. So you have this pattern of periods of long-term quietude and even normal behavior in here, punctuated by periods of incredible shock. So we have this quiet period and this period of shock, and then we have this long period of decay. And in this long period of decay is where you get these long-term upward moves, because as the VIX goes down, prices have a tendency to go up. But then when prices have gone up a long time and everything is quiet, yeah, too quiet, you get these sharp spikes, and then the volatility spike occurs. So at the research weekend last year, one of our professional money managers, Jim Carroll, presented a system that he uses in some of his longer term postures that takes a look at these characteristics and uses that as a form of market classification and when to invest long term, and had some exceptional results. And he brought that system to our workshop, and he was trying to figure out how soon after these spikes can he start getting back in, and what can he do to protect against those sharp spikes so that his longer term system would retain the gains that it made while protecting against these short sharp spikes. So we worked out some ideas, and all that's in our workshop notes and videos for the live trading and research weekend. But what I want to share with you is these ideas now. So the research then comes from some academic papers that took a look specifically at the behavior of the VIX. And so if we take this position that says the VIX itself muddles along, and then has these great big spikes up, and then has this long period of decay, and then it muddles around, and then has this sharp spike and goes up. What the academic research looked at was a really nice paper some years ago. They said they wanted to take a look at a short-term moving average and a long-term moving average, and then use the principles of comparing moving averages and moving average crossovers to determine if there was some kind of advantage that we could get by putting this in place. And so the first thing they did, let's call this in black a short-term moving average, and they used a 10 period, and then a long-term moving average, they used a 30. Now, when you have these long periods of decline, if I have a 30 period moving average that looks like that, and then a 10 period that looks like that, you can see that the 10 period moving average is going to be about here, and that the middle of the 30 period is going to be about here. So that's going to be the 30 SMA, and that's going to be the computed value of the 10 SMA. So on an absolute basis, you can see that when the 30 period moving average is greater than the 10 period moving average, what you are experiencing is a decline of volatility. And we know that in this entire period, it's good that you want to be long in here, and then you want to be short, or at least in cash, against these kinds of events. So I took a look at that, at their findings, and I realized that what we wanted to do was just compare the 30 to the 10, and as long as the 30 was greater than the 10, then volatility was declining, and that is a good thing. So what I did is create a risk index where we take the 30 period moving average of the VIX, divide it by the 10 period moving average, and just computed that. Now, if that number is 1.0, exactly 1.0, then you have the case where volatility will have just rolled over, so the 30 will have rolled over and the 10 will have rolled over, and in that moment, when they are perfectly aligned, you have the beginning of this decay. So any time that the 30 period is greater than the 10, then this number is going to be greater than 1.0. So it's going to be greater than 1.0. And any time the 30 or the 10 period is greater, that would be one of these cases where where the 10 has responded to this movement early, and then the 30 is slowed down by all of these low numbers. So the 30 is low, but it's starting to get bigger because we're adding these days of increasing numbers. So when the 10 is greater, you're in negative volatility. You have that short-term volatility spike. And when the 10 is greater than the 30, you'll have a number that is less than 1.0. So we can simplify this and simply say that 1.0 is the boundary between risk on and risk off. Now, what the research findings showed was that whenever this case occurred, that broad asset classes of commodities and equities and exchange traded funds and indexes, that those assets generally perform poorly, and the things that worked were things that were defensive in nature, like treasuries and bonds and real estates and other alternate asset classes. So I now call this the risk index, because what we're doing is we are indexing the value of the 30 and the 10 against the number 1.0. And when that number is greater than 1.0 in this area, we call that risk on. And what the academic research found was that and they were looking at things over 30 and 40-year periods, that whenever the 30 period was better than the 10 period, that's these long categories, that all those riskier assets like stocks, small caps, commodities, would do well, that you wanted to have risk on. You wanted to be exposed to those riskier assets while volatility of the market itself was declining. So you were getting better and better weather, if you will. That's when you wanted to be sailing on that risky ocean. But when you had this risk shock, that was the stormy weather. It didn't last that long, but that's when many of those long-term gains got eaten away in the sudden adverse move. So in general then, what I do is I look at this on a daily basis, and I say that whenever that risk index is greater than 1, that we generally want to be long. And as a measure of market condition in terms of volatility, that this is a time in which, in general, I want to have swing trade positions on so that I can take advantage of this generally upward tilting move in the markets. And that when it gets below 1.0 in the risk off area, so less than 1.0, then I'm expecting the market to have poorer returns, and so I am less inclined to take swing positions. You could say, well, I'm not going to take swing positions, or I'll take the ones that are looking to go short. Or for the swing positions that I have, I will make sure, especially sure, that my stops are in place. And I will be more likely to take short-term gains rather than holding out for the extra gains of longer term. So if there's ever a matter of question about whether to stay in or to get out, I'm more likely to get out when I have a risk index less than 1. Or I will look to take swing positions in the risk off assets like utilities or pharmaceuticals or treasuries or bonds. Or I might take fewer positions. So that in general is the strategy for how I use the risk index. Now I go a little bit further. So what I want to do is take a look at the directionality. I want to do a time series of that risk Z. So if the risk index is a daily measure, and that threshold between risk on and risk off is 1.0, what I notice is that because we're looking at the 30 divided by the 10, we already have smoothed that number because it's looking at a 30 period and a 10 period. So we already have some smoothing. So what that thing will do is have a tendency to be like this, and then start getting better, and that number will go up and it'll go down, and it'll go up and it'll go down. So what I have done is I took a look at a time period of the last 5,000 trading days. I wanted a long-term indication of what that risk index has done over time. So I looked back 5,000 days, and I found the average, and I found the maximum. What was the biggest number it ever had? What was the smallest number it ever had? And then let me find the standard deviation, and then let me treat the long-term performance as if it's between -1 and +1 on a z-score. So now I compute the z-score of each daily risk index, and now I've normalized it for statistical treatment. And now I have 3 areas where I consider this is exceptionally quiet, this is exceptionally volatile, and then this is normal if it's between +1 and +2. And now what we've got is a normalized treatment that as the z-score moves up and down like this, we have a nice statistical based way of understanding where today's particular value, whatever the risk index number is, we can now place it into the context of the last 5,000 trading days, and now we can get a statistics normalized view of what's going on, and I call that the risk Z. Because what we've really done is that we've taken the current reading, which is a number somewhere around 1.0, the computed value of the 30 divided by the 10, and now we've taken a statistical view of it, found the z-score, and now I plot a 90-day histogram of the risk Z, and that's what you see in the daily report. Now here are some things that we found of why this actually matters a lot. Let me pull up this and how it really pertains to swing trading. This is actually pretty cool. This whole risk Z is one of the 3 best ideas I've had in the last 20 years. Oops, that's the wrong one. Yeah, so this comes from some research at one of our earlier Kansas City live trading workshops and research weekends, and this was Tim, he was trading the mechanical systems in a particular way. He had done some minor tweaks to it, but he was generally following the main ideas of the swing trades, using some refinements from the ETF2 relative strength, but mostly I would say 80% of this was generated around the mechanical swing trades. And so what he discovered was that when he started applying the risk Z, this is that daily histogram, when he looked at his performance numbers of his trade log and then compared it to what condition was the risk Z in, these are the things that he found. So when the risk Z is at 1.0, then that means it's at the in the risk on, and it's getting better. What he found was that when risk Z went below 0, it got into the negative zone. In this region, he discovered that what he should be doing is reducing his position size, because this was one of those cases where volatility was going up, and all of those risk-on assets were starting to suffer and decline. And as long as this little histogram was going down, almost like a MACD histogram, only this is the risk Z histogram, this region number 1 turned out to be underperforming in the swing patterns. This was not a good time to be getting new positions. And if he was taking positions for his own reasons, then he discovered it was better to take smaller positions and to take fewer positions. And then what we noticed was that whenever this got beyond 1.0, beyond -1, and had this little turn, that in this region 2, this was the sweet spot. This region 2 to region 3 was the sweet spot. That, and certainly in region 2, that he really wanted to be taking signals, because this was part of that the volatility had spiked up, and that was generating this part of the histogram. And then as it rolled over and started to decay, this characteristic in here was generating region 2. And when it started to get back to normal, he started getting into region 3. And that region 2 was really the ideal time to be entering. That he could still take positions in region 3, but that he may have been waiting too long to get in, that he was more judicious about the size of the position and the number of the positions. Once it gets past 1.0, now you're starting to get up into that exceptional time period, and that's where those sharp rollovers would occur. This is where what his concern was. He didn't want to get in just in time to get the volatility spike. So as this region in 4 is where it started to top out at a distance greater than 1.0 on the risk Z. So as that risk Z is rolling over, this is an area where you want to make sure that you are properly managing your exits, being judicious about how many new positions you take, and monitoring your overall portfolio heat, because the market is doing one of these kinds of gizmos. In region 5, he did better by sitting on his hands and not trading. And really that region 5 lasted all the way down into when it got below 0 and was declining and had not yet bottomed out and started to roll up. So in this region, he was not really interested in trying to do swing trades on the short side. This, by the way, for us turbo traders and day traders, or intraday traders, this is the time that we want to be maximizing our day trading, because we're getting these large directional adverse moves intraday. So the risk Z not only helps guide me with my swing trading, but it also helps me with my asset allocation between how much should I be day trading, how much should I be swing trading, and it is a general purpose indicator in that sense. It gives me insights into market conditions on the basis of long-term, compared to long-term volatility. That is such a powerful lesson that I would encourage you to listen to this about 100 times a year and really understand what that risk Z is doing for us. A very important lesson. So that's what I mean about, so that's our answer to question 1. And it really, it connects with question 2. So that's what I mean about relative volatility and the risk index then, is how does volatility today as measured by the risk index compare on a relative basis to the historical volatility? And then the risk index is really looking at the VIX itself, which is a measure of volatility of the market. And because we have a belief backed by evidence that 50% of the volatility of your companies comes from the market, and 25% comes from the sector, and only 25% comes from the company itself, that if that volatility is such an important market condition, that if you get the market right, and we're talking about price action in the form of the RLCO, but also the volatility in terms of the risk index, that if you get that right, 50% of your results are going to come from getting that right, which is why I place such an important emphasis on market classification. So to clarify now, what does risk off means? It means that the risk index is below 1.0. So if you think about that little demarcation line, risk off means it's below 1.0. And what that means is it doesn't mean no new trading, but what it really means is take extra care because of the probability of increased volatility. Consider shifting your targets to the more defensive plays. Consider reducing your overall exposure. I can't give you a hard and fast rule on there because every single person in this webinar and in the world has a different risk tolerance, and the systems that you're trading have to be understood in terms of your overall market exposure and market trading plan. So I can't give you a blanket rule, but what I can tell you is that when we get into risk off, that the tendencies over long periods of time have been the riskier assets will underperform, the conservative assets will outperform, and that the market itself is suffering, and that you can expect increasing volatility shocks, and that your time horizon should be shortened to take advantage of the short-term price spikes and volatility spikes. You should certainly consider very carefully where you're placing your exits, and you should consider whether or not the gains that you've already made, whether it's more important to preserve those or to hold out for the historical returns of that system. Okay? So that's my answer to number 2. I would like to, yeah, okay, we'll cover next, what is ETF2? Let me pull that one up now. Should I have this prepared a little bit sooner? All right, so the background on ETF2. So the ETF2 is a system that is the most current version of one of my longest term systems of all time. Back around 1980, holy cow, that's 36 years ago, I started doing mutual fund rebalancing. And it was based on measures of relative strength that I was measuring in a very primitive way, looking at 1, 3, 5, and 10-week percentages. And on the basis of some analysis, I would pick the ones that had this blended relative strength improvements, and then I would rotate through mutual funds on the basis of that relative strength analysis. Late in the 80s and early 90s, mutual funds, it was no longer feasible to rotate mutual funds because they were the fund companies started restricting frequent rotations. They were starting to penalize you for that. They would kick you out of their accounts. But at the same time, exchange-traded funds came on board, which favored more frequent trading. And we've seen the explosion of those in the last 2 decades so that they now cover the earth and all its asset classes and allow you to do switching between positions at the cost of regular normal brokerage fees. So what I did was I converted my long-term mutual fund switching strategy to what I called ETF2 and produced a set of particular rules for some hedge fund guys that were using my reports to manage long-term assets for people that wanted a conservative growth strategy. So ETF2 is a particular rule set that was designed for hedge funds that wanted a very conservative growth opportunities. And what ETF2 did was it took a look at, I was measuring this database of funds on the basis of strength, consistency, and volatility or quality. And then I was aggregating those equally weighted into an overall average score, which would weight each one of these things by 1/3. So I had this great big database of funds, and every week I would measure them from 100 was the best and 0 was the worst on the basis of performance. And then I would segregate them into 4 color categories of green, white, yellow, and red on the basis of statistical performance. So it turns out the things that were in the green were the top 1/6 of performers. Things in the red were the bottom 1/6. In the white was above average in 1/3, and then 1/3 that were below average but not quite red. So on that basis, we could color code performance. And then what I was looking for ETF2 was to find ways to stay invested in systems that were all in the green for measures of strength, current strength, consistency, which was a 10-week average of strength, and then quality, what I did was a form of system quality number. So the details are not all that important, but I still produce those reports. And the reason I produce those reports is that each week I have this database of evaluating 1,000 ETFs on the basis of strength, consistency, and quality. Now, ETF2 is one particular rule set on how to choose which funds to own and how to allocate assets on a percentage basis and how to govern your portfolio heat. It's only one way out of many ways that database can be used. It turns out that the database is a representation, a modified form of relative strength, and there are a couple different ways that you can play it easily other than just following the ETF2 rule set. I'm going to give you the ETF2 rule set. It'll be uploaded. In fact, I think I already put it on the website for your prep work. The rule set is already there. So you can see the specific rules that were used in that conservative hedge fund. Now, the beauty of that rule set is that it protected a lot of people's retirement accounts during the meltdowns in 2003 and 2008 and 9. They had single-digit losses in their portfolios by following those rules. And so this is a very conservative rule set. It has a tendency to underperform a little bit during long periods of bull markets, but it definitely does a nice job of protecting long-term risk assets, and that's why I've made those rules set available to you. But what I want to say is that the DB itself, the ETF2 database, lets us do things like my good dear friend Robert Gardner, one of the original tortoises. He's a money manager. He likes those things that are green, that dip into the white and then return to green. That's like a triple screen system. He loves this upper end because it's easier for his clients to be in those positions. So he likes the upper side, and he likes that kind of pattern formation. My personal preference is I like things that were yellow and then red and then come back up into the yellow, because I like to be earlier in that life cycle. So if we treated the life cycle move of performance looking like that, Robert likes these things that do this. So he likes to look at the ones that are in the green. I like the things that were yellow, red, yellow, because I'm a bottom feeder and I like to play the return to value and then manage my trades. And so this ETF2 database I produce on the weekly report that shows these various measures of strength, consistency, and quality and average, and uses those 4 color codes. And then we are able to find ways to use these longer term measures of relative strength to find nice shorter term swing trades. So this is a form of core and turbo trading. So if we say that the long-term things like blended monthly rebalancing or the ETF2 database, These tend to be longer term positions that can last weeks into months into quarters. And if swing trades at last are lasting anywhere from 2 to 10 days, and day trading tends to be trades that last 1 day or less, it turns out that in the holistic view of trading, that we can find signals from our long-term blended monthly rebalancing in ETF2, and then when we apply our swing trading patterns, whether that's mechanical systems or the regression line crossover system, that we can find ways to put swing trade discipline and swing trade frames on these long-term outperformers and improve our performance by using things that have inherently relative strength advantages. In the same token, when we look at the intersection between day trading and swing trading, it turns out that those signals that are on mechanical swing trade patterns or some of our strategies turn out to be really nice day trading candidates, because we have an expectation that this thing that had a 5-day down is going to have a directional large move in the next 2 to 10 days, and I want to day trade those as well as swing trading. So we call this intersection between swing trading and day trading core and turbo. And by the same token, this intersection between longer term and swing trading can also be thought of as core and turbo, that your core positions in BMR can be enhanced or protected by the way you conduct the shorter term swing trading. And so now the power of swing trading is that you're learning techniques about how to trade in the 2 to 10 day time frame that actually gives you benefits, whether you want to be expand into day trading or you want to look at the longer term time frames. You're in that sweet spot in the middle by using swing trade techniques. And so now the ETF2 is this longer term look at relative strength that considers the performance of 1,000 ETFs all around the world and gives us insights into what the larger term and longer term patterns of institutional money flow tends to look like. So when we look at the world market model and we look at the US in the middle and we look at Asia and Japan, we look at Japan and Asia less Japan, and we look at the Europeans over here, and we look at Latin America and emerging markets down here, and we look at the gold and real estate markets over there. By using the ETF2 database, we can actually see money as it flows from the U.S. over towards Europe, or from Latin America to Asia less Japan, or from Asia back to the U.S. And then simply by using that ETF2 database, which looks at longer term look back periods, we can see how money is cycling between sectors, between regions, between geographies. And then the other thing that we can notice is that when we get signals that the market itself is collapsing, we'll notice that all of these things taken collectively start going down together. We can put our stops in place and protect against those sharp bear markets. And that's what the beauty of the ETF2 rule set shows, is that when money stops cycling but starts to get pulled out altogether, now all of these indexes are going down together and there's no good place to invest. That tells us it's time to invoke those that reduction of exposure to the equities. As long as there's something that's working, though, the ETF2 database helps us find that long-term relative strength, and so we want to be long on the things that are working. But when all of them go down together, the ETF2 rule set is a way to guide us on what amount of exposure we ought to have, and so that's a way to start using measures of long-term relative strength as part of the market mosaic for asset allocation and overall risk management. So that's what I want to say about ETF2. Look at us. We've already got 3 questions answered. Question 4. I track 3 trades for BMR ETF. Is it 3 or 4? It is 3. The BMR system is it has various trading populations that are proposed. and you can use other ones, but we use an ETF 13, an ETF, I used 32, and then there's like an ETF Max in there, or I'm sorry, 22 and 32. That's right. And so what we do is in each of these populations, these are the broad assets indexes that cover the world market model that I just described. It gives you exposure to the U.S., to Europe, to Asia, to emerging markets, and some of these other categories. And what it does is it computes their performance, and it has you own the top 3 for the next month. ETF 32, and in all cases, it shows the top 3 for ETF 13, 22, and 32. I use that same blended monthly rebalancing format to take a look at the Dow 30, the ETF 200, and the ETF Max as a way of using the same logic that is used to compute the BMR performance to look at these larger populations, because that's one of those where I'm using the BMR lens as a way to find relative strength performers that I might use for swing trading. So I use the core signal generator to do turbo trading with swing patterns and those things that have exceptionally strong performance, but also the things that are exceptionally underperforming. Because as a bottom feeder, what I know is that outperformance happens not only from the things that are at the top of the stack, but also those things that are at the bottom of the stack. Now, that's not part of the BMR system, but it's part of the BMR analysis that lets me find extreme outperformance and underperformance, because these are the areas that I look for nice swing trades as a return back to the mean. I look for outperformance from those things that have moved an exceptional distance. You will see this time and again in all of my trading techniques, because the RLCO Bollinger Band framework is nothing more than the same idea, but with a purely statistical measure that can be applied to any time frame. So the short answer to your question, is it 3 or 4? It's 3 when I'm talking about the explicit BMR system. Question number 5. The weekly report looks at the slope of the regression line instead of the regression line itself. How do we interpret that? So this is the idea. This is an advanced idea called the slope statistic. And let me talk you through that one. You'll see this in the weekly report as well. So the main idea behind the regression line crossover system is the following idea. That when you have price, you have these little price points, and you get this kind of chaotic and I can put a regression line on that, and I can smooth that out. And so I'm going to use the yellow to say this is the 30-period regression line, and now it's turning, and now it is rolled over, and now it is rolled up. And so we get this least squares moving average, which is another name for the regression line, has those characteristics. It smooths out the price, and it's much more adaptive than any of the other moving averages. Well, one of the things that I know is that, and one of my standard techniques is to say, let me take a look at the performance of that regression line during some look-back period. What I generally know is that what I'm looking at is the RL30, which is a really the centerpiece of my ideas here. That the RL30 is the trend. It's the condition of the trend. And so one of the things I know that is when here's a point where the 30-period regression line trend was going down, and this was the worst downward slope that it ever got. You'll notice that as we were computing the points on the moving regression line, that thing has a slope. As it rolls down and gets bad, there's a moment down here where it got as steeply down as it ever could get. So if these are the points of price at that turning point, we would say this 30-period slope looks like this, and then it got worse, and then it got worse, and then it got worse, and then it started to improve, and then it started getting better and better. So what I do is I compute the slope value of the regression line, and I like I always do, I look back 180 days or 180 time periods as context. I want to evaluate, let's say on this particular day, if I can compute the slope value on this particular day, and it's I'm going to make up a number. Let's say it's positive 0.5. How good? My question is, how good is that compared to the context? So I look back 180 days. I find the max, the min, the average, and then that plus or minus 1 standard deviation. And now I compute what I call the slope statistic, or the slope stat. And here's what we know on the basis of the slope stat. Let me show you how that looks on our weekend report. Actually, I actually do this every day. So we're going to find here's the slope statistic. So this is the slope statistic of the last 180 days. This zooms in on the last 30 days, and this is what each of those days looks like in the last 30. So chart number 1 shows the last 30 days of performance, and this is from last week's report, by the way. I haven't printed the current week, and that happens next. But from last week, these were the last 30 days of price. The blue line is the actual 30-day regression line. It's a straight line. That line has a slope. This moving blue line right here is the moving average of that slope of the regression line. And the black line is the average of the last 180 days. The two green lines are +1 and +2 standard deviations. So this is +1, this is +2, this red line is -1 and -2, and then this dotted line is the 0 line. Now here's what we notice on this is the last 30 days. The important one really is this one here, the slope compared to the last 180 days. Here's what we find. When you take a look at the 180-day average of slope, and then you look at the moving average of slope, whenever you have these turning points, so the blue line is the moving average of slope, and then this black line is the 10-period moving average of the blue line. When you have these crossovers, and they are more than 1 standard deviation outside of normal, these turn out to be very important turning points in market conditions reliably. Here was one where it turned. Whoop, I can't draw a straight line to save my life here. This chart right here just says, for reference, shows the percent stretch above and below the 200-day moving average. Shows you what price was doing. See this long period of declining regression line slope? That corresponded with a 15% sell-off in the S&P. It got horrible. And then there was a sharp rebound, and you had this huge improvement. And the best part of that move was right in here. And what happened was, look how smooth that slope of the regression line was. It went from a z-score of minus 1.5 to a z-score of almost 2 in an undifferentiated upward move. The market was improving in that whole period of time. So by knowing where those potential turning points are, we can start shifting away from this risk off and short side to a long side, get long in here. And in this whole period of time, we were able to book some really nice profits. When that rolls over at an extreme condition and it comes back towards average, I want you to notice the market was not really improving, but it became choppy. Instead of upward power, it became sideways choppy. When it got back to average and then began to improve again, this whole period of time was a new market condition in which the long side was favored. And now when the slope started to get really bad, this market was selling off. So I compute this thing every day, and I pay attention very carefully to turning points in the slope statistic of SPY. So this is the 180-day look back. This is the 30-day look back, so I can zoom in. And this is what that regression line looks like. Now this is how I use the 30-period regression line. Now this is very similar in concept to the RLCO crossover on the intraday and on the swing trade patterns, because really we're taking a look at the slope of those regression lines. In the RLCO framework, you have a 30-period moving regression line that generally follows price, and it kind of looks like this, and then it gets up to an extreme area, and then it rolls over. And that's the slow regression line. The fast regression line is at 10, and it's a little noisier, and it goes like this, and then it starts to do this. And so what we look at is these little moments when the 10 period crosses the 30. Here's a case where it touched it but didn't follow through. And then here's another one. Those areas mark off important turning points. And when we take a look at the price river, I'm going to draw the river in yellow because my highlighter only gives me yellow. What happens is, if this is the 30-period simple moving average and the river looks like this, when those RLCO crossovers, when they happen outside, and we put the Bollinger Band framework on this thing, when those happen outside the river, what you had was an exceptional price move that took everything outside of the normal river that's formed by this 30-period moving average plus or minus 1. When those RLCOs happen at extreme conditions, and the river would look something like this, when those RLCOs happen outside of the river, you now have been alerted that a crossover and a reversal of trend may be underway after an extreme move. It helps us change our orientation from long to short by telling us that this crossover may be significant. So that's my answer for that particular question, that sometimes I'm looking at the slope of the 30 period, and sometimes I'm just looking at the moving average of the regression line. Sometimes I'm looking at the slope of that moving average. And so that's a compound use of regression lines and slope. It lets us put today's values into perspective. Okay, number 6. And let me just say, we've had some pretty technical answers in here, and we're only 5 questions into this. If that stuff isn't as clear as it could be, I'd like you to listen to it a couple times, think about it, and then if there's still questions, I can cover some more next week. It's easier to see it in action on trade frames than it is maybe in a cold lecture like this. But that's how I would use these. I would use the recordings of these presentations. All right, so the next one up, number 6. In one of my essays, I mentioned that I moved to no lose quickly when the trade is profitable or in my direction. When do we actually move the initial stop to break even? When we have a profit of a half or an R, or when we have room of 1 ATR. On the swing trade, what I would generally say is the following. I would start with the 1R, the 1R trailing stop, whatever that may be. If you're using 2 ATRs or a weekly frog box, or you used a Z2, and I'll talk more about that when we get to the advanced patterns and framing. But whatever your initial R was, I generally recommend a trailing stop from that. Let me draw a blank screen to draw on. Generally speaking, what I would say is that when you have a trade frame and there was your risk, and then there was your 2R reward, and there's your minus 1R risk, and then that's based on yesterday's maybe chart looking at that, and we got an orderly entry, and boom, there's our entry, and here's our 1R. We're hoping that we get a move to 2R because that's what we framed, and then I would be following that with generally a 1R trailing stop. The 2R battle drill talks about if you see you have 2R, almost 2R in hand, it starts to roll over. I talk about how to accelerate that to capture more of that good win. But realistically, we can be aiming for 2R, and we might find ourselves a price rolling over all of these locations, and at some point it hits our stop and then we get out. Well, when you do enough of these trades, you end up getting a histogram from -1 to +2R. You get this histogram of trade results over a long period of time, and you have an average win, and maybe you have an average loss. My general idea is that if your average win was 0.6, once you're past 0.6 is the time that I would think about accelerating this stop instead of just being willing to give back a full 1R. Once you're past your average win, in my opinion, you should be starting to think about preserving your wins. Now, my general approach is, with my own trading, is that when I'm up around 0.5R in hand, is generally when I'm thinking in the following way, psychologically, that if my average win was 0.6 and I'm holding 0.5, my trailing stop, if I just use a trailing stop, would allow this to turn into a -0.5R win, or a -0.5R loss. It would really hurt my feelings that if I was so close to an average win, and if my average win is what's producing positive expectancy, and I just let that thing roll back and take a full -1R adverse move, and I ended up with -0.5, psychologically I would find that distressing. So what I talk about is this concept of no lose plus dinner for 2. And so I'm not just getting to break even. I want to make, when I get to about 0.5R in general, whether I'm day trading or swing trading, I like to accelerate my stop to the point where if this was my entry, I like to not just move to break even. I like to move that to a level where if it comes up and rolls back and I have to take this exit here, that even this small fractional gain lets me pay for commissions plus $100. Because if it came all the way back and broke even and I'm out my commission, I actually lost money. Maybe that's $10. And I like to say, well, it was close. I was almost at my average win. I gave it a little bit of room to continue to work, but it didn't. And I took this no lose plus dinner for 2 stop. At least I'm going to get, I paid for the cost of the commission. And if my cost of commission is $10, I can either take my wife to dinner in Kansas City. $100 buys a really nice dinner for 2. We live pretty cheap out here. That's a nice, or it gives me 10, it pays for my next 10 commissions. So no lose plus dinner for 2. Now what I won't do is I won't trail it with that tight stop, but I might be trailing it, then jump up to no lose plus dinner for 2, and then hold it at that level. And then if price moves in my direction, when it gets back to 1R, then I can pick up that trail again. But this is the same idea that you will notice that I use at the 2R battle drill. If it gets up around 2R and starts to hesitate, I talk in that video about how I look at accelerating in order to capture more of the outsized gain. That's really the same idea that I use when I'm around the average win. Furthermore, if I look back at previous levels of resistance, and one of those might be at the 2R, every one of these is a resistance line. Whenever I see price approaching one of those places and it starts to hesitate, I'm always thinking about how can I preserve any of these gains? Can I get to no lose plus dinner for 2? I'm not allowed to be surprised if it fails at resistance because it did the last time. And so I really invoke the 2R battle drill at wherever I see programmed resistance. So whenever you see me set up my trade frame and you see me putting in levels, usually in the form of purple lines, you'll see me finding areas of resistance, and I will say those are areas in which if it starts to fail, I'll invoke the battle drill and I will try to preserve those profits because I know how to re-enter. That's what I'm doing when I'm trade framing. So in general, what I would say is this: you have to know how your system performs, and you have to know what your risk tolerance is and what your psychological state is when you have money in hand and it starts to fail. If that thing is going up in your favor and starts to hesitate, and now that's your maximum favorable excursion, you have to say, how good is that? If you were aiming for 2R and you had 2R in hand and now it's starting to fail, are you going to really let that come all the way back to 1R just because you're trying to follow your rules? And if you give back a full 1R, if that makes you angry, then you're carrying forward adverse energy and emotion into the next trade, and then that energy is going to cause you to question yourself and your rule set. So my real answer to your question then is that start with, if it gets to 0.5R in hand, I would just give you general advice. Move that thing to no lose plus dinner for 2, and then learn what your own psychological reactions are. Learn what your histogram is and how you respond to these different size wins and losses, and then you can fine-tune your exit strategy to your own psychology and to your own performance and to the way that you may have adapted these systems. And in that way, you spend all your effort on managing your exit strategy as opposed to squirreling around with trying to fine-tune your entry. The entry rules are good enough to get you into some pretty good trades. The place to spend your time is on your exit strategy, because that's the one that generates your actual histogram of results and is the source of most of your emotional energy. Spend your time on that part of the system. Good enough entries are good enough. Spend your time on fine-tuning the exit strategy to your own psychology. That is a really strong message from me to you after watching our tortoise traders working through this. We spend much more time on how to manage exits in a way that is satisfying and productive, and trying to squeeze more results out of the trades that we're taking, and less time on trying to work on the refinements of entries. It's the exits that generate all of the emotions. So that's the lesson that I want to say, or the answer to that particular question. Okay, next. What are 1, 2, 3 exits in lazy W formations? This is nice. This one is actually an easy one, of course. Let me find my chart. You guys are doing a great job hanging in there, by the way. Okay. So this comes from our flashcard file. So a 1, 2, 3 entry looks basically, this is just a standard practice on any time frame. So here's a, we have an uptrend. We were in it for some reason. And when this bar closes, it made a new high. This is working bar 1. So bar 2 opens anywhere. And when it closes anywhere, when that bar closes, as long as it didn't make a new high, so we compare this one to this one, if this bar closes and didn't make a new high, then this becomes bar 2. And then wherever this one, this is now bar 3. Bar 3 is live. If it makes a new low compared to bar 2, before taking out the high of bar 2, so this is live. It opened here, made this little blip up, and now sells off. As soon as it gets below the low of bar 2, this is a 1, 2, 3 exit. So bar 1 was the highest high so far. It closed. This one closed with a higher low. That makes this bar 2. This one made a new low compared to bar 2 before it made a new high. This is a 1, 2, 3 exit. A 1, 2, 3 entry says in a downward trend, this is bar 1. Let me walk you through this. Actually, this may have been up here. This was bar 1 because it was the working low, still the swing low. And then it opened inside here, and up it just made a new low. That makes this bar 1. It made a new low. Up, that makes this bar 1. It opened here. Oh, it closed without making a new low. That means this was bar 1, and that was bar 2 because it closed. And now it opened here, maybe sold off a little bit, and now it made a new high compared to bar 2. That makes this a entry going. That's a 1, 2, 3 entry long. Or if I was short, this would be a 1, 2, 3 exit because I'm buying. But this is a buy signal. This is a 1, 2, 3 buy. Sometimes it's an entry going long. Sometimes it's an exit on a short position. But that's what we mean by the 1, 2, 3. All right, so now the next question was a lazy W formation. A lazy W formation on any time frame essentially looks like this: up, down, up. And what I'm looking at, and it goes the other way too, we have a low and then a higher low. So now this looks like the letter. I should have actually drawn that with a, sorry. So now this looks like a W. A perfect W would look like this, 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 this. If you got enough of those, you essentially would have a channel trade. And a perfect sideways channel trade is bouncing between these channel markers. And a perfect W would look like this, where the low and the highs were all identical. A lazy W, though, is favorable because instead of this thing coming down all the way to here and then finding support and resuming, it did this. It made this little move. And so we can now say here's a higher low. The higher low is this much. Now, psychologically, what are we to make of that condition? Why is that a favorable sign for buying? It's favorable because on this leg down, in the tug of war between bulls and bears, the bears were able to pull it all the way down to here before the buying pressure took over and pushed it all the way up. In this case, buying pressure came in early. They started buying it at this level instead of waiting for it to come all the way back here. And what that says is the buyers were more excited about buying at a higher price. Instead of letting it come all the way down to here before they started buying, they were in an urge. They were urgent to buy it because they think this thing is really going to go up. In fact, what they think is that on this next leg up, instead of going just to here, they think this thing is going to continue on past this point. So it may have slowed down, and then they start buying it right here. This is now tipping the scales in the favor of the buy side. So instead of looking like a regular W, we say it's lazy and it's tilted to the side. And so instead of a pure sideways band, if we were to rotate that thing on its axis, instead of being purely sideways, we now said that the momentum was generally to the upside. What we're seeing is this kind of price action, where you have this series of higher lows and higher highs. This is the classic definition of an uptrend. That in general, and you could call that a regression line if you like. But we have a series of higher highs and higher lows that describes an upward trend. A sideways trend would be one in which, yeah. So one of the ways we might say, is this a turning point, is we might just wait to see a 1, 2, 3 wherever it occurs. If it occurred right down here where the previous low was, we got a 1, 2, 3, that describes a sideways market. But if we saw a lazy W and we got a 1, 2, 3 entry, we might hypothesize and say, you know what, this might just be, instead of being this long-term sideways oscillator, the fact that we got a lazy W and a 1, 2, 3 suggests that this thing might break out of this channel. So now we have two ways of trading this. We might say, if I can get a 1, 2, 3 entry in here, or a regression line crossing the dragon if we're going to use the RLCO, but even if I don't use that framework, if I just get a 1, 2, 3 entry in here, and with this as a swing low, this improvement might tell me, let's go for it. And now this is what we would call the pocket. I call it a pocket when the trend reverses back to the upside, and the pocket is formed in this little space between the previous swing high and this breakout. We call this breakout here usually the emerging dragon, or my not later than entry. If it takes out the previous swing high as measured by the hump of the dragon, or the baby dragon, or the RL10, or maybe you want to use just the highest price ever achieved. I like using the hump of the dragon. If I can buy it inside here, I get this much price improvement, and now I have money in hand so that when it gets up here, if it starts to fail, this is where I might just cash it and get a fractional win or not lose dinner for two instead of waiting for this entry. If I wait for this entry, quite often that next move out is an explosive move. And now I'm trying to chase a runaway market, and I might get a bad fill. So I like to buy them in the pocket. And this is where those 1, 2, 3 entries, or the continuation pattern, if I got an owl down here, it made a move and now resumes, I can buy it in the pocket. That's where we start seeing this lazy W formation. And when I talk about pocket trading and the RLXD, that's where I want you to listen to and review those trade frames that are geared towards the RLXD. That's what I mean by the lazy W and the 1, 2, 3 entry, and in general how I put all that stuff together. Next question. Is there a possibility of conflicts between different types of systems? Yes. And how do we deal with that conflict, especially as end-of-day swing traders? I think that you start by reading the rules and look at the trade frames and the trading case studies and paper trading these things, and then find the ones that resonate most strongly with your trading beliefs and your trading proficiency and all of your experience. Find the ones that resonate the most with you, and then concentrate on taking those patterns and see how they perform. Then on the ones, what you'll find, the ones that are the most difficult for you to take would be the ones in which you would be trading in the other direction. Let me give you an example of that right now. In fact, we just saw an example of what could be a conflict. If price does this and gives us that lazy W, at some point, let's see here. Here's the 30-period simple moving average. That's the middle of the river. And this is our river. And so this is between +1 and -1 in that Bollinger Band river. And then this is the plus or -2 Bollinger Band, or the floodplain. And let's say that price still did this acceleration and it was really good. You might find and this is on any time frame, right? So we're talking swing trades here. When you see this price rolling over, you might very well see a 10-period regression line roll over. And at some point, the 30-period regression line is here. And look what we have right here. We have a pattern 1 in the RLCO framework. And on this trade, when we see that trade, what we say is our target is the Bollinger Band mean. And that is a legitimate trade frame. And we put a stop here and an entry somewhere around in here, maybe at the edge of the floodplain. And that would be our 1R risk. And we would be playing for +1, +2R. That's our 2R gain. So there's our 2-to-1 reward to risk ratio. So that's a P1 trade, absolutely, every day, all day. But by the same token, what if this pullback was a 5-day down? Or what if this was a 5-day down and you traded it and it pulled back and started to hook back up, and you saw that as a continuation pattern? And the continuation pattern suggests you want to take it long. Or the channeling signal says this pulled back far enough that you're supposed to take it long, but the RLCO pattern says you want to take it short. So you have a conflict. Which one do you take? That's why I get back to my original statement. You need to see which of these trade patterns and trade rules most closely align with your beliefs so that you can trade them with a minimum of anxiety, and then paper trade them to see how they perform for you, and then see how you might adopt one or the other patterns. You can't trade them both at the same time, or you're net neutral. But here's what happens. In order for there to be a trade, we have to be in something I call a critical state. And what that means is that when there are two groups of people that are looking at this. There are buyers and there are sellers. The sellers have to be able to look and say, there's a good reason for this thing to return back to the Bollinger Band mean. And the buyers have to say, I want to buy this at this point because I think it can go higher. If you didn't have any buyers, then all you had was sellers, this thing is going to keep coming down. If all you had was buyers but no sellers, all this thing would do is go up. But because you have both buyers and sellers, you have a little bit of hesitation in there. And we would normally say that in that critical state, a trade is possible because you have a strong argument for a move down and a strong argument for a move up. What we want to see is that if we could put a risk box around this thing, that really represents the area of indecision. Indecision. And we call that R. And as long as there are 2 or 3 to 1 reward to risk ratio, then you can take this trade to the downside and say there's 1R, 2R, 3R, because if this doesn't achieve 1R and starts to fail, you can say, oh, I guess the buyers really are stronger, and now maybe I can trade this frame in the other direction. So I'm going to tell you that our patterns are going to find critical states for you in which a powerful move in either direction is possible, and that by calibrating those moves by using R and informed by the regression line crossover and Bollinger Band framework and some of our other measures of computing reward to risk, that you're going to be able to see that, trade it in that direction if it starts going that way, without a belief that, oh, I was right this time and I picked the right direction. No, I'm going to tell you that you set up a trade frame that allowed you to get short if it starts failing with enough protection so that you don't lose a fortune if it reverses against you, but you can trade that within your businessman's risk tolerance. But if it starts to go this way, you can trade it that way. That's how you have to look at these patterns. When they are in conflict, it's because we are finding critical states in which a large move in either direction is certainly possible. That's the very definition of a critical state. The best of all critical states is a tiny little doji at the end of like a 5-day down, and it has a very tiny area of indecision, which says, if it goes out of the doji this way, I want to be long, but if it goes out of the doji that way, I want to be short, and we have a relatively small risk, but we have a relatively large potential reward. If it fails, it could come down to the next support level, and that might be 5R. But if it breaks out of the doji and goes to the 10-day high, that might be 5R. And so now I've got a 5R move in either direction. I have a maximum reward to a minimum of risk. That's the auto framer, my friends. That is maximum pain range compression. This is trade framing, so I do not have a directional bias, but I am prepared to trade in the direction that is indicated by the previous reasonable moves. That's the short answer for what to do when these, maybe it's the long answer. The short answer on what to do when these things are in conflict is to is to frame the trade in the way that in the past has been most successful for you on the basis of paper trading. And this is why I say that when you take these on, you should paper trade them until you have a histogram of results so that you can start seeing which one of these things works best for you. Paper trade it until you can then have confidence to prototype trading it, and that's trading it with live money but very small position size so that you can generate a histogram of real money, and then you can compare how does your paper trading compare to the real live money trading, but it's at a prototype level of risk so that you're not betting the farm. And then as the prototype trading goes in your favor, you can start increasing your position sizing per trade until you are now working at production level so that you are trading it at normal levels of routine professional risk. This is how you go from learning the idea with paper trading to prototype and real live trading at small levels of real risk, so you can see how either you or the system performs differently when you put money on it, and now you're checking your broker and your own psychology. That's an important intermediate step. And then as you get successful, as measured by statistics, you can grow this thing into full production level. Yeah, but Ken, what if I have multiple systems? You're doing this for each of those systems. That's what a professional does, is that you look to see which of these systems performs the best for you. and the way that you understand them, and the way that you test them, and the way that you analyze them, and the way that you check them against your own risk tolerance. And then you pick the ones that are working the best and move them towards production. And so you don't have to trade all the systems. You don't have to trade them the way I trade them. You have to trade them the way you trade them. But it should be, your decision making should be based on your performance. That's an important lesson for our workshop and for professional trading and for how to adapt these systems to your own use. You should listen to that presentation, several hundred times as well. Okay. How do we integrate the logic chain with swing trading end of day? The logic chain is nothing more than taking a look, for example, at ETF2, looking at the relative strength of sectors and the market, and then you should use the sector and market strength to pick the symbols that can rely on sector and market strength. So if I had a swing system signal for Intel in the technology sector and Goldman Sachs in the financial sector, if the technology sector, and I like both of those patterns equally well, and the market condition was up, but the technology sector was much stronger than finance, I might prefer Intel over finance because the logic chain of market to sector to target favors the signal that is generated from the stronger sector. So you can use that same idea with swing trading and end of day trading in order to choose between multiple targets. So if you have more targets than you have units of risk, you can prefer the ones that are in the stronger sectors. Number 10, the RLXD. Does crossing have to be done south side of the dragon or north side or outside of the river? All right, so this is a technical question about the RLXD inside the framework. So let me get my sketch. Okay, so the RLXD so let me get my pen working, sorry. So the regression line crosses the dragon. So we know that the dragon is a 10-period Bollinger Band. So it's a Bollinger Band 10 plus or minus 0.5. And we paint that in orange. So we're going to show, here's a bend in the dragon, and it has this little dotted line on the inside. So Bollinger Bands are based, the center spine of a Bollinger Band is a simple moving average. So the middle of that dragon is a 10-period simple moving average, and then in this case it's plus or minus a half. So plus or minus 0.5. Okay. When I talk about the RLXD, so the other piece of this is the RL. A regression line has crossed the dragon. We're talking about, this case, the RL10. So no matter where the river is, the river could have been down here, it could have been here. It doesn't matter where the river is. When we talk about the RLXD, all we're saying is that, and that was poorly drawn, is the RL10 was on one side of the dragon. It entered the dragon here, and it left the dragon here. Now the RL10 is on this side. This act of moving from here to here, that is the regression line crossed the dragon. That's all we need to know. So sometimes we want to say in a continuation pattern, we might do something like this. We might see that the river did one of these gizmos. And so it would not be unusual to see a dragon that looked like this, where you had, it's a relatively tight compared, because it's only a half, it's only plus or minus a half. This is the most normal characteristic yet on the when it's going from bottom to top. So now the RL10 usually looks like this. Because it's an RL, it's a 10-period moving average, but it's at least squares moving average. The regression line 10 is faster than the 10-period simple moving average of the dragon. So it moves faster than the dragon, and it changes faster. So price starts to go up, and you will see this. Here's where the RL10 entered the dragon and across the dragon. When it comes out of the dragon, what you just had was the RLXD. Now in the owl pattern, that is that's condition number 3, is that you had an RLXD. In the owl pattern, the other guy that we have in here is a 30-period regression line, and you would normally see it look like this. That we have a long and ambiguous move, that's pattern 1, or criteria 1. Criteria 2 is that you had an RLXD outside the river, that's criteria 2. Then the RL10 crosses the dragon, the RLXD, that's criteria 3. When the dragon rolls up and the 30-period Bollinger, or the 30-period regression line rolls up, that's numbers 4 and 5. Then you have an owl pattern. But the point I want to make is that all we mean by the RLXD is that is a description. That's a acronym for a term of art. That just means the 10-period regression line crossed the dragon. It started from one side and went to the other. So on this one, if price went up and then it rolled back, this might have been enough for the owl to exit. So that's an owl exit right there. So if this was where the owl entry was, because we had unambiguous move, pattern 1, RLXD, the dragon rolled up, the 30 rolled up, so we got our owl entry. So the owl entry occurred right here, and then price keeps going up, keeps going up, keeps going up. Awesome. And now the price rolls over, and maybe there was a 1, 2, 3. Maybe that got us out. Or maybe we exited on the near side of the dragon. Or maybe we exited on the far side of the dragon. That's really, to me, that's a reasonable exit point. And we say, in this, I'm going to take the owl entry, and I'm going to take the RLXD exit for your interpretation of the dragon or your implementation. Then here's an RLXD where it entered the dragon, came out of the dragon. In this case, it's on the north side of the river, and that was the signal for the exit. The RLXD is merely the technical description, the specific pseudocode for RL10 was on one side of the dragon, it entered and came out the other side. So here's a case where it was on the south side of the river. Here's a case where it was on the north side of the river. On this side, it wasn't a signal to enter, it was merely step number 3 in the owl. On this side, it was the exit signal for the owl trade. So that's the RLXD. Number 11. Hang in there, guys. We're almost there. You mentioned market classification and swing systems as part of Action Learning Journal for 10 weeks. Can these be done in parallel, or do you have to do them in sequence? I would do them in parallel. Because market classification occurs every day, but it doesn't change all that often. And then you should look at the market classification, and then you should look at the swing trade patterns that are firing, and you should be doing that as an integrated market mosaic and taking note of that each and every day, that you have you have certain swing trade information, and you have certain market conditions. You want to take all of that into account as you build your market mosaic. So I look at what swing trades are firing. What is the S&P's, what is the risk Z? What are the sectors that are working? What are the symbols that are working? So I take all of those things into account as I build my market conditions or my market mosaic to get an appreciation for the market. Because remember, 50% is the market, 25% is the sector, 25% is the company itself. If you're only trading ETFs, you don't even have to worry about company signals. It's now mostly the market. It's about 2/3 the market and 1/3 the sector. And that simplifies your life even further. So do all those in parallel as you build your insight into market conditions. Number 12, last one. I do a trade log in Excel and review it on a weekly basis, but I struggle to journal it. What is your advice on journaling? And you mentioned that's the best trading book we can ever read, and you'd like to know how to go about journaling. This is how I would do that. There is a link on the 4-part learning journal in the homework assignment. I'm 99% sure. If there's not, I will put it there. But generally speaking, this is how I link those things together. And this is the way that I think you can get the best benefit out of the material. All right, so let's say that you have a trade frame. So we got a signal, and then you set up your trade, and you had your little trade frame. You got your entry, and it worked, and you got your exit, and so you made a win of that much. And then the next trade frame, you set it up, and you got your entry up, and then it failed, and so we got a minus. And so you do all that stuff. Here, the trade journal consists of, you take a look at that trade and you say, how well did I plan, prepare, execute, and assess that trade? All right. And you make comments inside here, and you talk about, as part of your daily after action review, sorry, sustain, improve, and action, and then plan, prepare, and execute. And you could say, for this particular trade, I said, I did a good job in my planning because I followed all my rules and I found the signal and it was in a strong sector. So I give myself +1. I give myself a grade of A on that. Well done. And then on prepare, I went through and say I did my mechanical entry and I figured out my risk and my reward, and I looked at contingency plans, and so I did a good job, and I give myself an A. On execution, maybe I was slow to pull the trigger, and so I only give myself a C. And I'm doing my evaluation on here now, and I've looked at all the rule sets, and so I'm going to give myself an A on assessment. This is now a completed trade case study. All right. As a result of looking at that, you might then say, as part of your daily debriefing, let's say you made 5 trades that day, and for each one of those trades, you did one of these daily debriefs. Those are individual pages in your trading journal. You also want to have this chart down here, which says, now that I've looked at all the trades that I did today, or this week, if you're doing it on a weekly basis, one of the things that I'm noticing is that I'm doing really, really well on all my planning. So I want to sustain my strength. I want to keep doing that. But you might look at all 5 of your trade cases and say, hey, I only had 1 A and I had 4 Ds. I was trading things that I had not well prepared. I didn't complete the other side of the trade, or I didn't do the 2-to-1 reward to risk analysis. So in my preparation, what I want to improve on is this. I want to make sure that I do a complete trade frame, and I want to rehearse that. And then you may notice that, hey, I did on half my trades, I followed all my rules and I didn't hesitate. But on half of them, I hesitated or I didn't even take the trade at all. So these are the things that I want to sustain and improve. The last column in this is the action. Now, you may not be able to fix each and every one of those things each and every day. So in the action plan, you commit to pick on a daily basis or a weekly basis, pick 1 or 2 or 3 things. It said, I am specifically going to, and now you use a SMART goal. I'm going to specifically improve this thing. I'm going to measure success on this one. I'm going to commit to this action. It's going to be relevant to my overall trading plan, and I want to get this done in the next day. The trading journal is what you did with all of these individual trades. Your learning journal is this assessment and your commitment to action and the lessons that you're learning about your trading. All right, so you have, in my view, a trading journal and a learning journal. The learning journal inherits things from specific trades, and these are the things that you are going to do to improve your trading. But it could be other things. It could be something like, hey, I took the THARP Traders Test, and there were 3 things that I was supposed to do as a result of that insight, and I'm going to put them in my learning journal and say, I want to improve on these psychological aspects. I want to improve my diet and my exercise and my daily meditation. And those are things that go into your learning journal. Your trading journal nominates things that come from your trading practice. But your learning journal is actually, if I were to draw it as a Venn diagram, I would say your trading journal is a subset of your learning journal. The learning journal is the thing that you do that covers this larger area of things like your psychological work or your diet and exercise and meditation or whatever it may be. It could be things from your business plan. Your business plans could say, hey, I've got to do these 4 or 5 tasks, and you look back and when you assess that, you say, you know what, I keep neglecting these things, and in your learning journal you say, I'm neglecting those things because I have some psychological work that I've got to do. And so your learning journal is your capstone top level, the learning journal is your capstone top level process control book. Your trading journal is a subset of that, and it consists of how you take each of your trade frames and you go back, and it's like looking at game film. You say, here's what I planned, here's what I did, here's what I should have done, here's what I could have done, or here's some insights about that whole thing. And once you exhaust all that, that becomes a page in your trading journal. Your learning journal then takes all of those, plus all this other stuff, and it builds your action plan for long-term improvement as a trader. Okay? So that's everything I wanted to say on that one. Now, it's 5 o'clock. We've been going at it for 2 hours. This 1-hour webinar is now 2 hours. And so I want to give you a break and and get this thing recorded and posted. There were a lot of important lessons that are baked into that cake. What I'm going to probably do is invite somebody to listen to this and then to put the time hacks on each of those little miniature lessons so that we could have an index. So if you wanted to go back in the future and take a look at just one particular lesson, then we can do that. But I think that's quite enough for one day. You got plenty to think about. And so I'll go back to my earlier discussion about what we want to do for next year, or next year. Even I'm getting tired. Let's see. We covered all the FAQs. These were the topics that you should have been looking at inside the prepared material to look at those lessons, to come up with your questions. And then those generated those questions that I covered today. These are the lessons, the psychological lessons that I've asked you basically to look at for next week. So since next weekend is the last webinar prior to our workshop, what I would ask you to do really is make sure that you've gone over all of the lessons. Maybe if you didn't get a chance to look at all of these, take a look at those. Listen, maybe re-listen to this workshop and the last workshop, plus these, and then whatever. Send me your questions, and then what I will do is I will plan to do the same thing next weekend as I did this weekend, and that is just take the ones that you are specifically interested in and then try to place the answers inside the context of the larger lesson. So I maybe over-answered some of these questions, but they were all intended to address some of the larger concepts that we will work with. This is a body of knowledge about trading in this particular style that connects a lot of large level concepts. I think of these things in the following way. Like I have systems at the top level, and these are like the mechanical systems. They are rule sets that have stood the test of time and which can be robotically or mechanically traded, and that's like those 6 mechanical systems. Underneath that, where there is some discretion allowed, I have strategies. And these are ones in which we apply the concepts, but there is some discretion involved. And then I have techniques, and these are things that are like modules, like the 2R battle drill or the universal entry, or the RLCO framework is a technique. And these are modules that can be used to build strategies or build systems. They're like little components, little widgets. And out of these widgets, they're like battle drills that can be assembled to make strategies or make systems. And then finally, there are things that I just think of as tips, and that these are just things that are good to know and that round out our learning, small, nice to know or good to know or need to know things that inform these higher levels. So as you start learning this stuff, what I would say is the best way to do it is move in this direction. Start with those mechanical systems and learn to fit them to yourselves and to adapt them to yourself. And then as you start mastering those, you'll start learning that you can turn that system into a strategy, and you might have 2 or 3 different ways that you trade it, where you allow yourself some discretion. And then from that, you'll find techniques that really seem to work for you in multiple systems. And then you'll just learn good things along the way. So I would start in that way. Now, as a reason to advocate that, I want to leave you with the following short presentation about how to improve the mechanical channeling system. This is your goodie for hanging around this long. So this comes from our fantastic trader, a wonderful person, Catherine Crusoe. You guys will know her from the chat room, and she put together this presentation for last year in the 2016 Kansas City Live Trading Workshop. So what she did was she took the mechanical channeling system and she started trading it, and it had reasonably good results, but she had the sense that there was ways to improve it, and so she went about a systematic way of evaluating it, and she did things that took into account what if she looked at trading that thing not just in the bear, but also in the bull, and what about in sideways? And she found that over an extended period of time, she got improved performance on the sideways markets, and that sometimes in bear conditions. And she said, what if I use a 100-day moving average instead of the 200? What if I looked at the 30-period slope of the 30-period of the regression line for SPY? And she started investigating and looked at different, and she got different system quality numbers and different expectancies, and there were things that looked like they were actually added some refinements. And then she took a look at adding the risk Z and the market classification. And what she found was that there were very significant improvements that if you traded when the market was bullish quiet or bullish volatile, each of those extreme conditions jump-started the returns of when things were in normal. And that if she added the risk Z just on a standalone measure, that if it was below 0.5 or I'm sorry, greater than 0.5 or less than minus 0.5, that it was much better than when the risk Z was in the middle. And that makes the same point that I made, that extreme results come from extreme measures. So when things are quiet or volatile, these swing trades have an opportunity to do better. And so she has now modified, she said, what if I modify the rule set from as written to include this? So she modified that rule set. And the result she got was this. That's an equity curve with a combined arm, compounded annual growth rate. It took me a while to remember that. Compounded annual growth rate of 25% over a long period of time. And so what I'm going to do is I'm going to hang that rule set in all these slides on the website for you. But my point is that she learned that by starting with the system, then applied a strategy, refined the technique, and then added some tips. And she took what is a pretty good mechanical system into an exceptional system with the equity curve that really satisfies her as a trader. And so when she then went back and traded it forward using that same rule set, over the last 5 years, you could live with those numbers, I think, and those system quality numbers, and these maximum drawdowns. Plenty of trades. That's a system that you should be very interested in. So I will hang that. Now, that's just one of the systems that we teach. That's just one of the systems that we have improved in the live trading workshop and in the research weekends. And the best of those are the things that I try to present to you in this advanced swing trade. So I'm telling you, there's a lot of goodness out there. And just imagine the power of your network that you're developing now. With this dozen people that are going to be in this workshop, you have an opportunity to work together collaboratively now and in the future with people whose trading styles and maybe risk tolerances and purposes are similar. You have the opportunity here to develop a community of practice that will pay off large dividends for you as you go forward. And the Tortoise community of practice I offer to you as an inexpensive way of having the infrastructure and the resources to continue to learn and grow with us. So that's all I have for you now. I'm getting ready to take some pictures of my baby girl who's going to prom tonight. And I just want to wish the rest of you a good, safe weekend. Keep working, do your homework, send me your questions, and I look forward to the next webinar next Saturday. So that's everything I have. Take good care and keep your risk measured and your powder dry. I'm with you, but